All right, welcome to lesson 5. So we're talking about risk management, and this is probably one of the most important lessons. You guys need to be paying attention. If you need a notebook, get your notebook ready. And yeah, let's jump right into it. So risk management, and risk management, by the way, it's important because it saves your ass basically. It prevents you from blowing up your account, and it's just a really important factor in when considering growing your account because you don't want to be sizing in too heavy into trades, because if you go in too heavy within a trade and it ends up going against you, you don't want to do too much damage to your account. You want to grow at a consistent pace, but it's like the saying, um, steady wins the race or something like that. Like, it's all about being consistent and not about having super explosive growth, because if you take trades that are too risky, then you might get lucky and you might be growing your account super fast. But then once you encounter a bad trade, which is inevitable, you're gonna take a huge hit, and it's just not emotionally stable to have your account like go up and down, up and down. Like, you want your account to be like this, like steady, consistent growth. There's gonna be points where it's like maybe a little bit flat, but that's okay. There might be some dips, that's expected, but it won't be like you're up here and then you're all the way back down here. Like, you don't want that. You want an uptrending P&L curve. So the major part that goes into risk management is, of course, sizing. So there's a general rule that most traders follow, and it's that their total risk per trade is about less than or equal to 2% of their total account. So some traders, they choose to only go 1%, usually if they have a larger account, or if they have a smaller account, they might go 3, maybe 4%, but you don't really you want to stay in this general area of 2% of your total account. It's also very important to set a daily max loss. So if you're just not having a good trading day, then it's better to stop, before it gets really, really bad. So let's say that's $100, $500, $1,000. It's going to differ depending on, your account size and your own personal risk, but it's always important to set a daily max loss and make sure you follow it. Like, don't just set it and then, you reach your max loss, but you keep on trading. You're like, what if this trade, I'm going to make up my losses? Like, no, just stop trading. The market's going to be here for years and years. Like, it's always going to be here. So you don't have to make your money today. I know it feels like it, but that's short-minded thinking. And like I've told you guys so many times, it's all about thinking long-term. You got to think long-term with trading. And that's how you're going to find the most success. So set a daily max loss. And some brokers, they actually allow you to set one with them, and they'll automatically like not let you trade if you pass that. So look into your broker to see if it has that. I use Webull. I don't think they have that, but there's other brokers that do. So just look into that, and it might be helpful. Another thing to take into consideration is whether you're going to go in with one entry or you're going to size in. So for me, usually when I'm swinging, I like to size in. So I'll take that into account when I'm looking at my size per trade. So, if I'm looking to get 2 or 3 entries in, each entry is only going to be like, it's going to have the risk of like 1% or something along those lines. So take that into consideration when you're sizing. And like I said, I normally size in when I'm swinging trades. If you're day trading, usually it's one entry. You might have multiple exits when you're day trading, but it's usually just one entry. So it's not too complicated. But when you're swinging, it's a little bit, you want to think about it a little bit more. Another thing that's really important that doesn't really have to do with sizing, but it does have to do with sizing, but it's knowing when to be aggressive / protective. So, and we're going to talk about this later on, like in more detail of how to like systemize this, but it's all about knowing yourself, right? Like, if you know that you're performing well, like so far, like me personally, I've been performing really well. So I have to be a little bit more aggressive because I've kind of earned that, right? I've earned increasing my risk because, in August I had all green days. I didn't have a single red day in August. And so far in September, we're like 5 trading days in, I haven't had a red day yet. So, I'm currently in a good stage in my trading. So I get to be a little bit more aggressive. But let's say I was taking a lot of red days. Let's say I was taking 3 red days in a week. Maybe I want to size down and be a little bit more protective. And, it's all about knowing yourself and knowing the market, right? There's going to be different market conditions. Like 2020, like a lot of the year was really good opportunity, so that was the time to be aggressive. Some parts of 2021, like April, March, maybe not March, but like April, even May, maybe it was time to be more protective because things were slowing down as compared to how they were in the beginning of the year, and it's like that kind of stuff. So really take that into account, and again, it's about knowing yourself. Um, and the last thing is treat your P&L curve, so your P&L curve like a chart, and we're gonna go into that later, but basically it's the same thing as this basically. So if your chart is over here, up here, then it's time to be aggressive. But once you get down here, then you want to be more protective because you want to make sure you don't go from here to it being down here. So you want to start being protective until you start seeing green days again. Then once you start seeing green days again, then you can be a little bit more aggressive. Then maybe a little bit protective, aggressive, aggressive, and then this dip here you want to be protective, and then aggressive. So treat your P&L curve like a chart. And a way to like systemize this is using the strategy that I found. Oh, I skipped a slide from this video. So it's from Be the Story's YouTube channel, which if you guys are not subscribed to, I mean, definitely you should check his channel out. He provides a lot of good content. He does a lot of interviews with really experienced traders, and you could learn a lot from just 30 to an hour of him talking to another trader. Like, you learn a lot. So really recommend his channel. But there's this portion of the video where it's basically going to explain what I'm talking about. So let's listen to this real quick.
So the kind of foundation for the idea is we have to trade bigger when we're doing well, and we have to trade smaller when we're not doing well. So assuming that, I'm a trend follower, technically speaking, we're momentum traders, we're trend followers, right? Even if you're not like, whatever. If you're a momentum trader, technically speaking, you're a trend follower. So if I'm a trend, my trading is a trend, my P&L curve is a trend, then I can apply some moving averages to it and see what kind of numbers I have. So I'm tracking a lot of stuff with my P&L. The most important metric is average green day. And so basically I'm thinking, what's the most that I should lose on a bad day? Probably one average green day, right? Because right, it makes sense, right?
Yep. All right, if you guys are paying attention, basically he said that his total risk per trade is dependent, or his total risk per day is dependent on how he's been performing. So if in the past 20 days, for example, he's been averaging $500 P&L per day, then on a red day, the max he wants to lose is $500, because that way he knows that he can make that up on one good day, right? Like if he has a red day, but then the next day is a green day, he should be able to make up all the losses from that red day. You don't want to have red days where like it's going to take you a whole week to gain that back, because you're risking too much, right? And it's like we talked about, like your P&L chart is too volatile, and you don't want that. You want some stability. And so here's an example. So I just put in random numbers into here, and the average gain came out to be 529. So on any given green day, we can expect to make around 529. So what you can do is, that's your total risk per that day, right? So 529 is your total risk for that, for any red day you have, or for any day. And you can divide that by 3. That way you give yourself 3 chances. So that means that it would take 3 red trades in order for you to hit your daily max loss. Remember we talked about daily max loss, setting a daily max loss? It would take 3 trades, which gives you a pretty good chance to not hit it. That way it's not like, oh, I hit one bad trade, so I'm done for the day. That's a little bit like not giving yourself enough room, because red trades are pretty often, so you don't want to just have one red trade be like your stopping point. But 3 is around a good point, and you can adjust this, like if you want it to be 4, 2, just divide it differently. But yeah, that's an example. Or you could also do it where it's the average from your total gain. So if you divide the total gain by 22, you would get 305. So you could also do it that way, which gives you a little bit less risk. So and you would want to do this. This is more like he talked about, like the EMA curve on your P&L, and this is more like just taking into account the green days. So the reason why you would want to do this is because it takes into account the red days. So let's say you're on a losing streak, and it's gonna affect this. But if you're on a losing streak, it won't affect this, because this is only taking into account your green days. So you can choose which one. Like I said, If you want, like if we talked about here, if you want to be aggressive, you can use this one. But if you want to be a little bit more protective, then you could use this one as your total risk. So, yeah, it's a little method you guys could use to systemize, and treat your P&L curve like a chart. That way, when you're performing good, you're risking a little bit more, and then when you're on a downturn, you might be risking less until you start getting green days again. Once you start getting green days again, you're gonna earn your risk and then increase it. So hopefully that made sense. Hopefully that helps you guys out. If you guys were struggling with risk management and knowing how to size into trades or how much you should be risking, that's a good system to use. Another thing I want to talk about, this kind of goes into psychology and executing, as we talked about in previous lessons. But pretty much, before you get into a trade, you want to factor in the trade as a loss, pretty much. And that doesn't mean that the trade is going to end up being red, but before you enter a trade, like, tell yourself that money is gone, right? So let's say my account's at $10,000 and I enter a trade with $500. In your mind, tell yourself that $500 is gone. It's up in the air because now you've given it to the market, and only when you end up selling that trade, then that money returns to your account. But when you're in that trade, that money isn't yours, it's the market's. And the reason you want to do this is because if a trade starts going against you, you're not thinking about it like, oh, I'm losing $100 on this trade. You're thinking about it, no, I'm still recuperating the $400 I still have in the trade. Does that make sense? So you're kind of thinking about it differently, and this helps you in executing because, again, the big issue a lot of traders have, and I mention this a lot of the time because it's a huge issue, and people, they know about the issue, but they just don't correct it. That they're in a losing trade and they're still hoping that it goes up. They're not selling it for a loss because they don't want to accept that they're wrong. But the simple fact is, you have to execute and make sure you stop out of the trades when you're supposed to. You have to, man. Like, that's the only way to avoid big losses, and you have to avoid big losses in order to be profitable. Like we said here, you want to have big losses where you're up here and then you go all the way back down here. Like, what are you doing? Like, just sell it, and then if the trade ends up running without you, that's okay, bro. There's going to be thousands of other trades. It doesn't matter about one trade. One trade is not going to make or break your account, or at least it shouldn't, if you're taking into account proper risk management. So, yeah, that's just a good mindset to have. Like, once you're in a trade, that money's not yours anymore. And then if you're down on it, don't think about it as, oh, I'm taking this loss. Think about it, I'm recuperating the rest of what's left in the trade. The final thing I have for you guys is this simulation, similar to what we did in lesson 1 or 2, where we did that simulation, but this just makes it easier for you guys. So if you go to this website, it'll take you here. And pretty much you could put in your account size. So let's say you have a $10,000 account. You could put in how much you're investing per trade. So like we talked about, what would be 2% of the account? So, well, that's just 200. I didn't really have to take out. Wait, what the fuck? It's just $200, but I'm just gonna show you guys, so you know I'm not lying. So $200 is our total risk per trade. So if we're investing 5,000, our stop loss is what? 4%. That's a little bit low, so I'm gonna actually make this 25%. So just to show you guys, if we're putting in 2,500 per trade, our stop loss is pretty much 10%, because 10% is 250, and 2% of our account is 200. So we're investing 25 into the trade. Our stop loss is at 10%. Our target return, if we want to have a 3-to-1, is 30%, and our probability of loss, let's just leave it at 50%, and let's see what we get, and then we can kind of mess with it and see what other results we get. So let's simulate. Oh, okay. So if we got 50 wins, 50 losses, taking all this into account, our account would be at 103,000 after just 100 trades. So this should show you guys the power of having a good risk to reward ratio, which we've talked about in previous lessons, and limiting your losses, because Watch this huge difference. And by the way, you can see through all the trades that you would theoretically have, right? And you can mess around with all these numbers to plug in numbers that match what the results you're getting. So look at this. So let's say you're not limiting your losses. Let's say you're having big losses. Look what a huge difference this makes. Bro, now we're losing money. Do you see this? That's why you got to cut your losses, because that way it's easier to have a good risk to reward if you're cutting your losses small. Because if you're letting your losers run, then you're going to end up having your average loss is going to end up being all messed up, and you're going to have pretty much a 1-to-1 risk to reward, and that's going to require you to have a really good win ratio to end up being profitable. Because you see here, if we're winning half of our trades, that's still not enough, because it's not always going to be 50-50. Sometimes even if your probability of losing is only 50%, sometimes you're going to lose a little bit more. So that could end up hurting you. So that's why it's really important to have a good risk reward, even if it's a 2-to-1. Let's do a 2-to-1, for example, with still a 50% win ratio. Let's see what we get. We get 37,000 after. So we basically 3x our account, having just a 2-to-1 risk reward. 2-to-1 is really not even that hard to achieve. And again, it's a 50% win ratio. If we made it so our win ratio was like 70%, which is what I kind of average. Let's see what we get. 163,000, bro. Starting from 10K, 163. Just having a 2-to-1 risk reward and a 70% win ratio, which is a little bit high for that risk reward, but that's very possible. And investing 25% of our account per trade, which could be a little bit high, so let's adjust that. Let's say it's only 20%. Let's see what we get. 90,000, bro. 9xing, 10x, pretty much 10xing our account almost after 100 trades with these parameters. So you guys can mess around with that, plug in stuff that matches your current results, and just play around with it, see what kind of risk reward ratio you need, what kind of win accuracy you need, and to be profitable. But yeah, that's pretty much what I got for you guys. Hope you guys enjoyed that. Hope you guys were able to learn something. If you guys have any topics / questions or anything you guys want me to cover in future lessons, just let me know. Add me in the Discord and say you should cover this, you should explain this more, and I'll go ahead and do that in future lessons. But yeah, hope you guys enjoyed. Hope you guys learned something. Other than that, I'll catch you guys in other lessons. Catch you guys later. It's been me, Zero, and I'm out. Peace.
I say I love you, you say I love you too. Somehow it don't sound the same as when I say it to you. What's been going on? Can you tell me please? And I'm not trying to start a fight, I just wanna believe. Seems these days it gets quicker every time that you leave, but takes hours for you to come to me.